Okay, here we go with part 2, mutual funds and other investments. Just like any other security that you may want to buy, there is always a commission for a purchase. So there are always some fees that are associated with investing. What we're talking about in this particular example, at least in the beginning here, is what we refer to as loads. So you can either pay a load or not pay a load. Therefore, we have things called a load fund, where you would actually pay to purchase a mutual fund. These range in amounts, typically not more than 4%. However, what's different from load funds from stock commissions is that they're not round trip. You typically only pay one way. So you may pay 4% in the beginning, but when you sell the fund, you probably won't sell at all, or won't have a load at all. The back end loads are less prevalent in the marketplace than front end loads, but in this case, you wouldn't pay, when you buy the mutual fund, you wouldn't pay a commission. However, when you sell it later on, you would pay a commission. And hopefully, if it's a good mutual fund, it's going to grow in value. So if it grows in value, the load that you pay in the end would be more than the fee you would have paid in the beginning. So you get to choose how you want to pay the commission for many mutual funds. Now, there's also something called a 12B1 fee, and these fees are charged to cover some management and other operating expenses. These are usually very low, typically less than 1% or so. But essentially, it's a fee to help with management of the fund itself. There are other fees and costs, though. There's a management fee, right? This is paid to the professional money manager who administers the fund. There's going to be some administrative costs, right? There are exchange fees if you transfer money from one fund to another within the same fund family. That is very rare. Most of them have conversion fees or conversion services that are actually have no expense. But regardless of what the fees are, the SEC requires mutual funds to fully disclose all their fees in a standardized form. So here's the next slide, talks about, well, this is what it would cost, or what the fees are associated with buying this mutual fund. You can see here that the charge or the load on purchases is 3%. There's no charge on reinvested funds. There's no deferred sales charge. There's no back-end load fund. That's what this is referring to. There are no exchange fees, but there is an account maintenance fee for anything under $2,500. That's $12. Management fees, 0.45% is the management fee. This particular fund doesn't have 12B1 fees. It has other expenses. So the total expenses of managing this account every year is 0.65. And of course, that comes from the assets of the fund. So they give you a little example here, and they say, well, this is what you can expect to pay if you buy this fund. In 1 year, right, if you invested $10,000 and it earned 5%, you would pay $364 for that year for the fund. Over 3 years, you would pay $502. Over 10 years, it would be $1,086. The reason this is important is every mutual fund that you can think of, every mutual fund by law is required to provide this table. So you can compare these numbers to any other mutual fund. And of course, you want to get a good return, but you don't want to have to pay very high expenses for getting that return. So if you kind of think about how fees are assessed, Class A funds are the front end kinds of funds. It's 0 to 4.5%. They have no backload. They may have a 12B1 fee of 0.25. Essentially, they have an expense ratio of around 0.7. Class C, they give you the points. The expense ratio is around 0.7. So when you buy into a mutual fund, you typically are going to get very similar expense ratios, but how that is paid and how that is doled out, if you will, is just a matter of marketing, right? How do you want to pay the expenses? You get to choose as the investor. So how might we calculate the fees and funds on a mutual fund? So we have a mutual fund that has an NAV of $20. Income distributions were 15 cents. Capital gains were a nickel. The ending NAV was $20.10. So this particular mutual fund, if we follow the formula here, earned 1.5% for this time frame, for this period. And of course, it becomes a little bit more complicated when you incorporate dividends that are reinvested and you do something longer than one time period, right? If you're looking at a year where you may get 4 distributions of dividends, and you might get a capital gains distribution in there, and you also buy or sell some mutual fund shares in between, the formula becomes a little bit more complicated in calculating the actual return on an investment. So what are the costs and the impact that these have on performance? Again, remember, there's no such thing as a free lunch. So everything has an expense. Now, the thing that I don't like about this table is that they're providing us with a statement of impact, but yet they're altering some of the numbers, if you will, right? So we're really not getting a true picture, right? They use an 8% load on a mutual fund, and anything, if I remember correctly, and this is just coming since I'm thinking about this, anything over 6% requires special authorization from the SEC. Typically, these are going to be a maximum of 4.75%. So when you incorporate that here, these numbers change dramatically, right? That they're talking about the impact on cost. This is really, I feel, the textbook is giving an improper analysis of the actual expenses. If you're going to hold a mutual fund for a very long time, typically a A-class fund, front-end load, will have a bigger fee in the beginning, but it has much less management fees, total expenses, from that point on. Where Class B funds and C funds, those funds ultimately have much higher funds or expenses because they have to pay the people who are administering this account. So I believe that this is a little bit of a misnomer here, right? Where they say Fund C on these expenses, this is the impact on costs, right? Again, it does show that it's less, but I think it's actually much less than what they're describing here. They're saying that these B shares here, these are the best ones to have because over time they have the least impact, and I just think that that's not correct. What happens with respect to taxes is that the mutual fund itself does not pay taxes. It's what's referred to as a pass-through security. So taxes are only paid by the investors. The fund investors don't control the timing of sales of securities. It's done by the management of the company. So what we are interested in is, obviously paying taxes is important. You want to pick a mutual fund, though, that is not so active that the tax burden is so high. They refer to this as high portfolio turnover. What that means is that within the mutual fund, there's so much management going on that even though you might be getting a higher return, you're going to get a higher tax burden. Because every time a security is traded, there is a capital gains implication. So average turnover here, they say, is 50%. Quite frankly, you would rather see something closer to 30%. The more efficient they are with respect to taxes, the more of the money that you earn you get to keep. So now let's move on to exchange traded funds, talk about them a little bit. And these are primarily index funds. They refer to spiders, diamonds, and cubes, right? Spiders is the S&P 500, diamonds is the Dow Jones Industrials, and cubes is the NASDAQ. So the advantages to this is they trade just like stocks. You can sell them short, you can buy them on mortgage. Typically they have lower expenses, so that means they're a little bit more tax efficient. The challenge, though, is that these prices might not reflect NAV. You could pay higher or lower than NAV when you purchase these types of mutual funds. And again, they have to, since they trade on a market, on exchange, you have to buy them through a brokerage. So exchange traded funds have grown dramatically over the last several years, where people are starting to take advantage of this concept of index funds. Now you need to choose whether you want an exchange traded fund or whether you want a mutual fund that is creating its own index fund. Both of them should mimic the returns on the stock exchange or on the market that's trying to follow. But we need to understand, what can you do with those funds? What are the advantages and disadvantages of trading, etc.? So it adds another layer of complication when you're trying to decide what kind of funds to buy. If you kind of look at the world, you can see that unit investment trusts are very small. Mutual funds is the biggest piece of the pie. The exchange traded funds are growing fairly dramatically over the past decade or so. So what kind of research can we find or detail is there about returns? There's been some research that shows that the Wilshire 5000, which is an index fund, basically, if you use that as your marketplace, most professionally or actively managed funds have lagged that index in 27 of the past 45 years. This evidence they're saying is weak but suggestive. Well, to me, that tells me weak is a problem, right? I want to see strong evidence that mutual funds cannot beat the stock market on average. And I say here that bad performance is more likely to persist. So that basically what that means is when a mutual fund does badly this year, it's more likely than not it will do poorly in the next year as well. So here's our graph that shows these. And again, you can see the active funds are the blue. I prefer line graphs to these bar graphs. The black are Wilshire. And you can see that in general, there's times when the market is losing. It seems that on average, at best, it seems even up that the Wilshire and active funds or earn the same rates of returns. But you can find time periods here, years where the active fund did better than the Wilshire. So again, I feel this is kind of an improper analysis when you think about this. If you go out to a mutual fund screener and you request all the mutual funds that have earned a rate of return higher than, just pick 10%. If that's the return that you're interested in, you will get many choices, many options of mutual funds that earn better than 10%. So again, there's lots of opportunity out there. So again, just to kind of continue with this analysis that they're playing, they're basically talking about how mutual funds have been investing, and this is 71 to 91, right? 65%, the top half of the mutual funds were in the top half. In the 80s, 51.7% of them were still there. So basically it's showing that there is opportunity for successive growth. However, from time to time that changes. In different decades, how things rank and how they perform, you get different results. So I'm not really sure what the textbook is trying to tell us here. There is the old wives' tale that mutual funds cannot beat the market. That is absolutely not true. There are mutual funds that have beat the market and have done it successfully for many, many, many years. So again, just the importance of this is to understand that there is evidence out there that sometimes mutual funds don't do as well as the market does. So how mutual funds are ultimately sold is a little bit different than the way stocks are sold. Right? When a stock is initially sold in what's referred to as the primary market, in the very beginning, the company has to go through registration. For a mutual fund, every time an investor buys a share, if you buy into a new share, let's put it that way, then that is what's referred to as a primary market. So if you decide that you want to invest in a mutual fund at Fidelity, Fidelity will provide you with a prospectus when you buy those shares. If you decide to sell some of those shares and buy another mutual fund, they will send you a prospectus for that mutual fund. Now, if you buy more shares of the original fund, they don't send you another prospectus. However, you will get one every year as time passes. So what you need to know about this trading, right, this process, is that in this document, the prospectus, it gives you investment objectives. It tells you what they're going to do. It illustrates the fees and costs. It provides all the information that you really need to understand what's going on inside this particular mutual fund and what their objectives are. So how can you use mutual funds? We can talk about something called an accumulation of wealth. Obviously, you put money in there and you want it to grow over time. So your objective is for capital growth, right? So again, the more you move towards this accumulation of wealth concept, the more risk is likely to be in your strategy. For a storehouse of value, you're really looking to maintain the value of your investment. So you don't want something that is more on the risky side. So you want to get a decent rate of return, but you're going to invest in things more like money market funds, short and intermediate term bond funds, something that's going to have a more stable, less volatile kind of a return. In the end, sometimes people think about using mutual funds in a speculative way or a short-term trading mechanism. And this really is totally contrary to any common sense. Mutual funds are investments that have an underlying long-term investment horizon. So investors that aggressively trade in and out are trading against the concept of which the money was invested. In addition, they also have fees that could be substantial, especially for the front load fees. Again, if you're thinking about investing in mutual funds, it is a longer term kind of a strategy. And short-term trading, as I mentioned, is contrary to most of the objectives and strategies within mutual funds. So what is the selection process? First of all, you have to decide whether or not you want to even invest in mutual funds. Do you want to increase diversification? Do you want to have some professional investor to make the choices for you? And do you want to use stocks and mutual funds? I mean, there's nothing that says you can't use more than one investment vehicle. So the objectives, right, is you need to kind of compare the mutual fund's objectives to an investor's objectives. What is it that you want, and what does the mutual fund want? If you want aggressive growth, then you probably shouldn't be buying a money market mutual fund. You need to understand your tolerance for risk, right? What is the purpose of this investment? What is the time frame of this investment? In the end, what services are offered? Now, that typically turns out to be a moot point because most mutual funds offer the same services. Now, the market is so competitive that there really is no outliers, if you will, if you think about services that are offered. So where can you find information? Quite frankly, I think the best place to find information about mutual funds is what's referred to here as Morningstar Mutual Funds. There's also a website called Kiplinger. In our research, we're going to explore those sites and look at some of them to try to figure out where we should ultimately go to get information. So how do you figure out what mutual fund you want to buy? Well, this slide comes from the text. I would like to add one other piece above this bar, right? That we're obviously interested in all of these things, but you need to find a mutual fund that will meet your needs. My suggestion is you need to find a mutual fund that offers 30, 40 or more different types of mutual funds. You don't want a mutual fund family that only has 2 choices or 5 choices. You want to invest in something that has a lot more opportunity for you to make choices and fine-tune your investment strategy. But once you find a fund family, then we address these issues. We want to look at performance. We want to measure and find out tax efficiency. What's the fee structure? We want to make sure our fees are relatively low. Will there be funds in there that are going to fit your portfolio? What is the maturity or the tenure, if you will, of the fund managers? I have a tendency to kind of rule out any mutual fund where the fund manager has less than 3 years experience. I don't want somebody graduating with their MBA and now they're managing a couple of $1 million and they don't really have any experience of the market changes. You need to think about load or no load, closed or open. All of these are choices that you ultimately need to make. Again, we mentioned about where you can find this information, right? Morningstar, Yahoo. I mentioned the Kiplinger. There is a place called the Investment Company Institute. That's a great place to go to find out and get information about mutual funds in general. So in closing, let's kind of think about some concluding thoughts. How do you make money when you invest in mutual funds? The mutual fund is a portfolio of securities. Each one of those securities has returns. Their prices will go up and down. They will pay dividends, or if it's a bond fund, they'll pay interest. So there is income, there is revenue that comes from within the portfolio. In addition to that, the mutual fund itself can change in value. So that mutual fund value can increase or decrease depending on the value of the entire portfolio, etc. So there are three ways to make money when you think about measuring performance in a mutual fund. So we need to know the number of shares you had at the end of the period times the ending price. You subtract from that the number of shares at the beginning of the period and the initial price. And of course, you divide by that. That will give you the holding period return for the mutual fund portfolio, for your mutual fund investment, right? So this will include, since we're doing prices beginning and end, it includes distributions, right? It looks at a specific holding period. And again, this is really for a 1 year period, not really functional for a multi-period example. And finally, let's talk a little bit about risk. Market risk is important because mutual funds are so well diversified, they perform very much like a market will, or a segment of market that they're targeting. You need to be aware of the effect that the general market has on investment performance of a mutual fund. They're going to follow the stock market much like the stock market moves. So there is market risk, but there's very little, if any, ever, any company-specific or non-diversifiable risk. Conservatively managed mutual funds tend to have less risk of loss than aggressively managed one. Hopefully that's obvious. So there are differences in management practices that you need to understand the management team. This is something that's a lot more difficult to investigate than the rest of the details that you can find for a mutual fund. So that is the basics of mutual funds and that investment category, if you will.